when you're time locking your Bitcoin, it's fully self-custodial. So you're never giving up those keys at any point. And that's what's so critical.
Welcome, everybody. This is Buck Joffrey, the Wealth Formula Podcast, coming to you from Montecito, California. Today, before we begin, I want to remind you there is a website associated with this podcast. It is called wealthformula.com. Lots of resources there, including the opportunity to join our accredited investor club. Take the opportunity if you if you do make over $300,000 per year and have a net worth over $1 million outside of your personal residence, to join the club. It's free to join, and it basically just allows you to see deal flow. That's pretty much it. That deal flow is not seen outside of the network because it's private placements you've probably heard of, right? So anyway, go to wealthformula.com, sign up for Investor Club. Today, we're going to talk about Bitcoin again. I know a lot of you still probably are sitting on the sidelines with this. Lately, the price of Bitcoin has been extremely volatile. Well, it's not volatile compared to what it historically has been, but it's been volatile. But listen, I will say this. If you told me Bitcoin was going down by 50% next year, I would hesitantly believe you. Okay, but there's no way that you can convince me that Bitcoin will not at some point be worth $500,000 per Bitcoin at some point within the next 5 years. I mean, that could happen in 2 years, and then you could end up coming back to $100,000. But I'm convinced that it ends up there. I mean, think about what's happening. ETFs everywhere, treasury companies holding Bitcoin, rumors of central banks buying it. An American Bitcoin reserve is on the table. It already exists. It's just, are they going to actively buy it, or are they just going to confiscate it and hold it? Now, that being said, the volatility is a real thing. And so what I think is really important is that you should not put money into Bitcoin unless you commit to it for 5 to 10 years. Just buy it and forget it. Don't look at the price. I mean, what I will say is, say a couple of years down the line, if all of a sudden you're hearing people talking about how Bitcoin went crazy and it's, worth $1 million or something like that, then yeah, you can pull it out and sell it. But, the volatility is a real thing here. It is not something you want for money that you need tomorrow. Okay. Now with that Bitcoin, you face one other problem. Bitcoin is kind of like gold, right? Unlike apartment buildings and stuff that we do in accredited investor club or investor club, there's no cash flow, right? Other coins like Ethereum and Solana do have mechanisms that are called staking that allow for yield, but Bitcoin does not, because in fact, its beauty in many ways, in the way it's designed, is there's not a lot of moving parts. It's a vault of security, and that's pretty much it, right? And that's why it's like gold. I know some of you are thinking, oh yeah, well, there are some ways you can get yield. There are companies, and you're right. There's companies like BlockFi and Celsius. They're traditional finance companies. I think BlockFi is out of business. I think Celsius as well, basically because when Bitcoin went way down, they basically, the companies folded, and a lot of people lost Bitcoin in those situations. In fact, with BlockFi, long story, but I lost a decent chunk there too when that happened. Now, in those cases with these, centralized traditional finance companies offering yield on Bitcoin, the big thing here was that they actually had custody of your Bitcoin. If you have custody of your Bitcoin, you can't lose your Bitcoin, right? That's a really important part of this whole Bitcoin ecosystem. As it turns out, there may actually be a way to get yield from Bitcoin while keeping it in your own custody, keeping it in your own wallet or whatever, right? That's what we're going to talk about this week on Wealth Formula Podcast, because we have a guy who's creating that entire ecosystem. This is an OG, Rich Rines. He's an OG Bitcoin guy, and a lot of interesting stuff we talk about. So we talk about initially the yield thing, which I think is a really useful thing. But then we go on to talk a lot about, the other issues around Bitcoin right now. Again, if you are not involved with Bitcoin, I think it's important, whether or not you buy it, to be in the know, learn about this stuff. And this is a good way to do that. So when we come back, Rich Rines.
Wealth formula banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash flowing investments. Here's the key. Even though you borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Rich Rines. He's a Bitcoin OG from the class of 2013 and one of the key architects behind the core blockchain. Rich previously led the money movement engineering team at Coinbase, helping to facilitate over $1 trillion in value transfers, and now serves as founding contributor to Core DAO, which is building a scalable self-custodial yield layer for Bitcoin. He's also the CEO of Element Wallet, which integrates stablecoins encrypted messaging into core ecosystems. Rich brings deep experience in both traditional finance mechanisms and mechanics and blockchain innovation as well, making him perfect person to talk to about how Bitcoin is evolving into a yield-bearing asset class. Rich, thanks for joining the show.
Thanks for having me. Really excited to chat here today.
So let's start with the big picture when we talk about staking in crypto. My audience, I think, some people, I would say probably half, are pretty crypto savvy by now because I've been talking about it since 2017 as well. However, let's talk about staking and, what did that actually mean and why has it been easy for some coins like Ethereum, Solana, but not really so for Bitcoin?
Happy to unpack. There's quite a bit to unpack there. So I think we take one step back and we kind of think about the origins of crypto, right? You had Bitcoin, which first came onto the scene in 2008, 2009, and it was based on proof of work, right? And proof of work is solving cryptographic puzzles. When you solve those puzzles, you help secure the network, and we're all kind of familiar roughly with how Bitcoin works. Energy, scarce, finite currency, and that was sort of the genesis of this whole movement. And somewhere, let's call it 2017, 2018-ish, you started to see a shift from people looking at proof of work and some of its scalability limitations primarily, because you do get a security benefit of proof of work that you do not get the same way with proof of stake. You get a different mechanism, which is still secure, but not as secure. And there was this desire to move to a new mechanism. And you saw Vitalik, a lot of the folks in the Ethereum community really pushing this even earlier. We saw the first wave of, proof of stake change really come to market in the 2017 cycle. And with that change, you now have a different mechanism for security. And instead of solving cryptographic puzzles to go produce blocks and secure the network, you have weighted governance or weighted voting based on the amount of tokens that you have. Sometimes that also factors in governance, sometimes it does not. But that's actually how you secure the network, is you have a large amount of the underlying crypto. And what was solved during that time period was the classic nothing at stake problem. Usually credited with Jay and team over at Cosmos, but there's a variety of different people that have their own, kind of solution to that problem. But that was really the advent. So you have to kind of look at the history to then think about where things move throughout modern times. Solana and some other chains, started proof of stake, and you got other groups like Ethereum that started proof of work and then migrated proof of stake at some later point. But it's a critical design as part of the consensus layer of these protocols. Neither is necessarily better or worse than the others. There are just different trade-offs. One of the big advantages, though, of proof of stake in this case is that you have a mechanic in which, by holding the token and staking it to help secure the network, you receive some economic benefit in the term of staking rewards, which makes these assets productive in a different way. And if we think about, Ethereum DeFi and its trajectory over the last, 5+ years, diagonal proof of stake and yield bearing tokens, etc., really is what brought the full blown DeFi summer wave. So I can go as in detail as you want to, or keep it high level.
Well, I want to kind of drill down a little bit on the mechanics of staking, because describe for people, again, a number of the folks listening have done it, but probably more than half have not. So, and if you could explain sort of what you're doing in theory there that actually creates yield, and how that yield and where that yield is coming from.
So it's going to vary based on system, right? But talking about like just generic in terms of proof of stake, you are getting paid by the network to help secure the network. Because if we think about how these networks have their voting power in terms of the right to go create blocks, it is looked at it typically as the weighted average of the amount of validators in the ecosystem that are part of that block producing set. There's different different paths, whether it's delegated proof of stake or proof of stake. But in general, those that stake or delegate are helping to secure the network, and they receive emissions from the network to go do so. Some blockchains are finite supply, some are infinite. So those emissions might tail off forever into the future, but you're getting paid for work that you're doing to help secure the network.
Where does the payment come from ultimately? Meaning, like, are those tokens or coins, are those created by the network to pay, or are they coming from some transaction fees? I'm asking in part because I'm wondering if there's an inflationary element to this.
Also depends on the system, but if you think about Bitcoin, right? Bitcoin has block rewards and emissions, and they also have transaction fees, both of which come back to the miners in this case. In most proof of stake systems, you have emissions and transaction fees, both of which that come back to the stakers in this case. And they may or may not be involved in block production, because those roles are typically separated in these systems versus them being combined in the Bitcoin nomenclature. Many of the proof of stake systems are inflationary, but it is not a system tenet that you must have. The theory there is very similar to Bitcoin in that as time goes on, you need the transaction fees to overwhelm the emissions for these systems to be sustainable at over the long run, if you will.
Let's talk a little bit about sort of the limitation with Bitcoin, if you would. Again, just trying to maybe create a little bit of an example for people. Obviously, we are not proof of stake; we're proof of work. Maybe kind of just explain, if you can sort of just give an analogy on exactly what that is, and then the limitation there, why there's a limitation of creating yield.
So I think Bitcoin's simplicity is a feature, not a bug, to be very clear. What we've collectively built in Bitcoin over the last 15 years is a institutional grade settlement layer for digital gold. And I think that in and of itself is very different than what originally Satoshi wanted to create with its peer-to-peer money system. But it actually stumbled upon a very large use case that actually meets a very critical need for this trustless settlement of quite large scale today. And I think the importance of Bitcoin will only continue to grow over the decades to come. And with that, becoming digital gold, there were a bunch of trade-offs that were made when Bitcoin was designed. So it's deliberately slow, it's not programmable, it has very limited expressivity, but that's one of the reasons Bitcoin has been able to remain so secure for so long, right? It has a very limited attack surface area. And all of those are very great reasons of why, Bitcoin is this, perfect digital gold on top of its finite scarcity, very easy to understand monetary policy, etc. But it does limit the ways that you can go put your Bitcoin to work. And, the phrase that I've used, in many times is Bitcoin's been kind of a pet rock for the last 15 years, but an amazing investment and, something that I've been very proud to be a part of for a very long time. And the genesis of Core was really around, okay, we have this, perfect digital gold. If I want to go do something with my Bitcoin, how do I go do it in a trust minimized way and allow this Bitcoin to go get used in this decentralized world of applications, whether they be simple yield or whether they be much more robust, full Turing complete applications. And that was really the idea of, okay, let's go, build this layer. And there were really kind of two components that Core created. One is its Bitcoin App Store. So it allows you to build decentralized applications on top of Bitcoin full expressivity of what you could do and any, full smart contract platform. And on the other side, it's a Bitcoin yield layer. So if you want to passively earn on your Bitcoin, or you want to build more complicated yield products on top of Bitcoin, you can now do that with the core ecosystem. And that was a massive unlock, because for all of the rapid growth that we've seen in the Ethereum ecosystem over the last 5 years in particular, we helped, or we're helping to actively usher in that wave on Bitcoin by making it this yield producing asset for the first time, and then allowing for these different range of applications and use cases. It's no longer an either or, it's a both thanks to core.
Describe what core is exactly. I know you just mentioned it with the this ability to build apps, but let's back up. Sort of like is this sort of a second layer, like an L2 layer on top of Bitcoin? Where does the yield come from in this situation for people who are using it?
Yeah, so let me unpack what core is in more detail. So core is an L1. It's more technically known as a Bitcoin sidechain. We would argue that there are no Bitcoin L2s today. I think maybe as time goes on, maybe we will get to more true trustless L2s, but as of now, nothing fits that definition. So the best that you can do is have an L1 that's secured by Bitcoin. Core has over 90% of the Bitcoin hash securing it. So we're easily kind of number one in terms of most of those metrics. And we do welcome new technological advancements that will allow, potential L2s, or even to get to full, Bitcoin security as time goes on. And the kind of two real kind of key components of the core ecosystem, to go into that next level of detail. One is it's a full L1 blockchain that is EVM compatible, which means any application that you can build in Ethereum, you can build on top of core while being secured by Bitcoin, right? It gives you that additional layer that is, so important in this case. And the other kind of critical distinction there is our ecosystem is Bitcoin based, right? So core is the gas token, but the decentralized protocols, borrow lending, perps trading, you name it, those are all Bitcoin denominated, right? So the idea here is for people to put their Bitcoin to work, not just being a substitute for Ethereum DeFi. And we do see some different user behaviors in terms of Bitcoin holders versus Ethereum holders. On the other side, it's that Bitcoin yield layer. So as we talked a little bit about proof of work and proof of stake, in proof of work, only the miners are the ones that receive those transaction fees and the block rewards. So what core does is it allows you not only to stake your core tokens, but you can also delegate hash. And that's where that 90+% of the Bitcoin hash comes in. But you can also stake your Bitcoin. So you can time lock your Bitcoin and earn yield and transaction fees from the core blockchain for doing so. And how those two kind of come into place is now, as a Bitcoin holder, you can also earn by holding your Bitcoin, helping to secure the core chain, versus just being a core holder who's helping to secure the chain, right? So you have these multiple ingredients in the soup of how core is secure, and we reward these different consensus participants for the value that they bring to the network.
In order to participate, is this like a decentralized app, or is this a internet site? Like where do you access core from?
So core is the blockchain, right? So you communicate over classic RPCs, but all of that is connected on the internet fundamentally. But the way to think about accessing it is you can access it through your favorite hardware wallet. You can access it through browser wallets, through a variety of different applications. And critically, you can also access it through Bitcoin wallets, right? So how our mechanism works is if you want to just stay on the yield side and you just want to earn yield in your Bitcoin, you can time lock it. So the idea is that you provably encumber those funds for some period of time. And then in doing so, you're helping to secure our blockchain and you receive the block rewards for doing so. And that's one participant. We see a lot of institutions do that, high net worth individuals, general Bitcoin holders, you name it. But the demand for Bitcoin yield is the most popular, asked in all of crypto more than anything else. And if you want to take the next step and you want to, bridge, swap, wrap, et cetera, and come over into our ecosystem, you can do that in your favorite EVM wallet, right? So you have the ability to fully engage in Core's DeFi ecosystem using, kind of a wallet of your choice, one that you've been, probably familiar with for several years. We view these different participants on a continuum. So there's some Bitcoiners that we can just offer education to today. They're not ready to do anything with their Bitcoin yet, and that's totally fine. There's a large group of folks that wants to go earn passive yield in their Bitcoin, and that's where staking comes in. If they want to earn higher yields, but they're not ready to fully wrap, swap over, et cetera, they can dual stake. So you can earn higher yields by staking both core and Bitcoin. And then finally, if you want to come over to the full Bitcoin DeFi ecosystem, you can do so. There's 150 plus applications with which you can go participate. So it's really about bringing people from one end of that spectrum over to the other end as time goes on.
Got it. So, again, I have a number of people who definitely own Bitcoin because we've been talking about it since 2017, in some cases, very large sums of Bitcoin. And so I know a lot of people keep this stuff in cold wallets. Maybe it's a Ledger wallet or something like that. Is there going to be something built into the Ledger wallets that would let you sort of just link with Core at that point?
So we have full Ledger support for Core staking of both Bitcoin and Core, and it's critically done in clear signing as well. This was done as a partnership between the two groups. So Bitcoin is not, again, not the most programmer friendly. So what this does is it demystifies it. It lets you know exactly the different parameters that you're putting in there. So with that Ledger grade security and legibility that you would want from your hardware wallet of choice. So that was a big announcement. I think we put that out there August of this year. So it's fairly new, but it was a big one to get out there. There's something like 20 to 30% of the world's Bitcoin is all held on Ledger wallets. So now all of that is, very easy and accessible for, any Bitcoin holder out there to go keep their Bitcoin in cold storage and go earn yield on it. And this is probably a good, zoom in on the yield mechanism itself. So when you're time locking your Bitcoin, it's fully self-custodial. So you're never giving up those keys at any point. And that's what's so critical. If we think about how people have earned yield on Bitcoin historically, it's come up through counterparty risk, right? Whether it's BlockFi, Genesis, Celsius, you name it. It was send your Bitcoin somewhere, wrap your Bitcoin somewhere, whatever. And then you may get your Bitcoin plus yield back in the future. And historically, that's been a bad endeavor. Not always, but historically it has. So it's critical here is you retain that Bitcoin the entire time. That UTXO lives in your wallet. So there's no situation there unless you lose your private key, right? Which is something that no one can protect you from, where you then, lose access to that Bitcoin. So it's the highest grade trust assumption that you can have, meaning that you have to trust actually no one, right? So there is no better trust assumption in doing so. And what that does is by maintaining that, again, you can see it in your wallet, all that is very clear and easy to understand. And the yield is coming from securing Core's ecosystem. There's no lending, borrowing, or anything else going on under the hood because, again, we don't have access to the underlying Bitcoin to do something like that, even if we wanted to, which we do.
What kind of yields are you get people getting on Core? I'm sure it depends on whether your level of participation, the amount of Bitcoin you have, whether you have Core tokens, that kind of thing. But give us an idea.
So you can participate, to your point, at any point along that spectrum. So if you just stake Bitcoin, you earn a lower rate. It's like 10 to 20-ish bips. And the idea there is it really pays for your assets under custody fees at a major custodian. And the idea behind that is like the minimum attractive yield, if you will. But what we try to get people to do is to do what's referred to as dual staking, which is staking both Core and Bitcoin in increasing amounts. And the idea there is that we want you to participate in multiple facets of our ecosystem, right? We don't want you to just participate on one side because critically what we're trying to do is make Core the second asset that Bitcoiners care about, right? We want this to be the gas token of putting your Bitcoin to work. So we want you to participate on both of these sides. And now if we think about the roughly 650 million of Bitcoin that's staked on Core, more than 50% of that now is actually people participating on both sides. So we still have a lot of work left to be done there, but it's awesome to see this convergence. And that's a convergence that no other Bitcoin project has been able to find so far, where that ultimately is the name of the game, right? It's so hard to convince Bitcoiners to go use a new product or service that's not Bitcoin. So you have to crawl, walk, run. You have to have incentivization to go make that happen. And then finally, the math and the underlying mechanism, ultimately needs to make sense. Can't be points or yield farming or anything like that. It has to be something that's sustainable and durable.
If you do participate in some of those other things, what's the potential, what is the potential yield? I'm asking mostly just because I just know that there's a lot of people in this audience sitting on Bitcoin and saying, well, maybe I can get some yield, but maybe not for 20 bips, but.
No, sorry. I realized I totally forgot the $1 million question. Yeah. So if you stake the max amount of Core and Bitcoin, you can earn about 5% new Bitcoin. So it's actually very high. And it's on this gradual scale, right? So what we want you to do is start with either, small amount of Core, no amount of Core, work your way up into that top bucket. And then as you get there, you're delivering the max value in terms of security and benefit to the Core ecosystem. And this rewards you with a very attractive APY.
how much is core right now, and how much, and just in terms of somebody being able to get 5%, like how much core would they need to buy?
So I can't really talk about price for a
Oh,
number of a
okay.
number of
Yeah, I
reasons,
get, I
but
get it. Sure, sure.
yeah, all of the calculations are easily available on our docs. But the way to think about it is we have these buckets. So there's different amounts of core that is required for each Bitcoin. And I think how I tend to think about these in a acceptable way to discuss on this podcast is really in terms of like LTVs, where the lowest LTV is like roughly like 3% of the Bitcoin position. The highest LTV is roughly like 10% of the Bitcoin position. So they're very attainable amounts of core in order to go acquire, to go earn that yield.
Yeah, got it. Got it. Let's kind of backtrack a little bit. Like in terms of, there are lending, you've talked about some of the historical ways people have gotten yield or, have used lending. For such an asset that is so secure, maybe volatile, but certainly secure, it seems like interest rates are often so high in terms of borrowing. And then, on the other end, yield is generally so low. Why is that? I mean, I'm just curious. I mean, in terms of being able to, usually when I'm thinking of the example of BlockFi, which unfortunately I used at some point years ago. And, yeah. And, and there, the yield wasn't great, but if you borrowed, it was actually really high rate. And I'm thinking in the meantime, when things went to hell, they just liquidated, like massively just liquidated people out of their positions very quickly. So the risk to them was pretty low. So what is the idea behind that, high interest rates, that kind of thing? Just because there's not enough competition? Is that basically it?
So it's a multifaceted market, and this is, one of the things that we're ultimately trying to solve here with Core's staking rate is you should have to go beat the staking rate on any lending and borrowing agreement, because that should be your benchmark. And you should have to probably do some sort of a multiple on that, because you're able to go do this with no counterparty risk, right? So if you're actually taking on counterparty risk, okay, what is that worth, right? It's probably not worth 5%, maybe it's 10%, maybe it's 15%, right? But this should actually create a material benchmark that people can use. And we think that's a net good for the overall financialization of Bitcoin. In terms of your question of like, how does this, kind of market come into place? There's all sorts of Bitcoin lending, and, all are not created equal. Some have, very credible counterparties and are fully collateralized. Others are totally uncollateralized. And there's a whole spectrum there. But in general, people don't like to lend out their Bitcoin. And if they are lending out their Bitcoin, it needs to be at an attractive rate for them with which they can underwrite, potentially not having that Bitcoin come back. And that, back in 2021, et cetera, before we had a lot of these blowouts, the market clearing rate for that was a lot different than it is today. And I think that is really, an important metric. The other thing that we see a lot of people do is collateralize their Bitcoin to go do stables or other sorts of like low grade farming, et cetera. So you just have a lot of competitive pieces there that are hard to fully quantify, but you just have these market forces that are, fairly inefficient, and, very few real players in these markets, it says.
Yeah. Yeah. Let's talk about, we've talked about core so far. I mean, what are the real risks? I've had friends who were using, DeFi, I think maybe like wrapping Bitcoin, and I got one guy lost like $4 million of Bitcoin. And, obviously we don't have those issues because you just mentioned there's not an issue of counterparty risk here. Can you talk about what the potential risks are? Is there a risk to the network risk? I mean, can you say that it's pretty much zero risk?
So I never say anything is zero risk, because
Right. Sure.
That's just not something I like to do. The risk in this case is that core explodes or something else, which is extremely unlikely, and you just don't receive your rewards, right? That's the max loss that you could have in this case, is that there was like essentially some core that you could have claimed and you didn't claim, and then there was some categorical issue or catastrophic issue. But that's the highest grade assumption that you can have, right? You can't there's no case in the system where you do not wind up with the full Bitcoin position, which is ultimately what everyone is trying to protect in this case. And that's very different than wrapping, swapping, bridging, etc., where now you have counterparty risk. And that counterparty risk you need to be compensated for, whether it's smart contract risk, bridge risk, you name it. But those are material. And it's not to say those are bad options. It's just whatever you're doing, you need to be fairly compensated with which for doing so. And now that you have this way to go do this safely with Core, you just need to, kind of price out those other risks appropriately. And I think there are great markets out there, particularly in Core's ecosystem, where you can go wrap your Bitcoin and go deploy it. But you just have to kind of know what you're getting into. And how we tend to kind of address all yield questions in general is like, if you don't understand the yield, you are the yield. You have to fully underwrite any protocol that you want to get involved with, whether it's Core or otherwise. And only when you get comfortable with it should you deploy. But the best starting area of all Bitcoin yield is deploying Core or deploying your Bitcoin on a Ledger wallet in Core's Bitcoin staking, because you just can't get anything more secure than that. And it's a great kind of crawl, walk, run into more advanced tactics of strategies.
I mean, I'm curious on like the traction you've gotten. Again, there are companies out there, institutions that are out there that have a bunch of Bitcoin earning no yield. Michael Saylor goes out there, all of a sudden gets 5% on his own Bitcoin through strategy. That could seriously change his own business model. Do you see those kinds of, are you seeing any traction with those big players for Core yet, or too early?
So one, there's an education problem in this market generally, and we spent the last several years helping to educate folks. And the new digital asset treasuries, or DAT meta, has actually been very useful to us, because what many people have solved in these DATs so far is, how do I go get assets into the vehicle? How do I grow the assets? And not everyone is Michael Saylor. And even Saylor has had issues with financial engineering recently. I think it's very solvable. But in general, you can only financial engineer so far. And then you need to look at additional sources of yield and the benefits that can bring you. And that's what we're seeing, is a lot of experimentation, mostly privately, but seen publicly, from some of these larger Bitcoin treasuries, because everyone wants yield in their Bitcoin. So then it comes down to, what's the best source of yield that I can do? And that winds up being Core. And if you look at many of these vehicles, they've got just very specific covenants that go into the assets that they have and what they can do with those assets. And almost all are restricted from lending and doing that sort of stuff. So when you need yield that is counterpartyless, and that's where we really shine. And I think that'll be a very large narrative that you'll hear way more about over the coming quarters, where that's really the next competitive battleground for these large Bitcoin corporates, Bitcoin treasuries, where now you need to go earn that passive yield on your Bitcoin. And I think net is just the next wave of financialization, right? Like if as a Bitcoiner, for a long time I resisted this, but I think we're at the stage where Bitcoin is a nationally important asset and a globally important asset. And now we need to go find ways to go earn more of it and to grow larger and larger Bitcoin balance sheets.
What's your take on what's going on in the markets right now? I'm just curious, just want to shift a little bit. Obviously, you've been in this space for an awfully long time. And I should have asked you a little bit about that. 2013, how in the world, what were you looking at in 2013 that made you think about, getting into Bitcoin, but, well, let's just start with that. I mean, I should have asked you at the beginning, but I mean, you've been in it for a long time. What did you see in this? And is this what you thought it would be?
So I originally heard about Bitcoin, I want to say it's 2010 or 2011. We actually had a college professor that was teaching us all about computer security and introduced us to the Byzantine generals problem. And I was like, wow, this is a fascinating problem. And he's like, oh, this guy Satoshi Nakamoto, or a group of people invented this solution, and, it powers this technology called Bitcoin. And I didn't understand at the time, wasn't interested, and didn't really fully understand it, because I didn't take the time to really consider the economics behind it and the change that this could bring into the world. By 2013, I reconnected with Bitcoin, and that was when the moment clicked, where I was like, oh, it's not just a solution to a tech problem. It's actually an alternative traditional financial system. It's a non-sovereign store of value. And the implications of that became clear to me of, okay, if this thing succeeds, it will totally reimagine the world around us. And hopefully we'll be able to get to a spot where we can change the banking system and hopefully, solve the fiat monetary crisis. Like there was just so many of these globally important shifts. And I was, hooked. Like, and I also had studied in college, both economics and databases, which is essentially what Bitcoin is. So it was like a perfect kind of match of a young and really interested person in the underlying product, and then kind of having the right skills. By 2017, I was like, this is what I want to do for the rest of my career. And, kind of the rest is history, but it was kind of a perfect aligning of interests.
And you think about like 2013, and I was listening to an interview. Somebody was interviewing Dan Moorhead, of Pantera Capital, and he was, Bitcoin class of 2013 as well. And obviously, he already had a lot of money, but he was, I guess he was convinced on, he got really into Bitcoin and tried to buy $2 million of Bitcoin. And the problem was he couldn't figure out how, because there was nowhere to, like everywhere he looked, it was like a $75 limit or a $300 limit. And that was like his biggest problem. Like you don't have that issue anymore. And then there's the issue of, having all of the technical skills that you needed back in 2013. Everything's pretty easy right now, even for, a guy like me. Hardware wallets and all that, they sound intimidating to people sometimes when they haven't used them. These are just not very difficult things, right? I'm just curious in terms of like your vision. Did you kind of see this world? I'm just curious in terms of what you thought was going to happen versus what has happened so far.
Definitely got it wrong at the time. Back in the early days, we were all focused on Bitcoin's money. I think there was a lot of hope at that point, and I've got a lot of very expensive coffees from that time period where we thought that it was going to be used for day-to-day commerce, and like that's how we were all going to pay each other, and I think there was a lot of interest and excitement around that at that time, and I think that was the original vision, just to be totally clear. And I think we've mostly failed at that, but we again have created this digital gold that it has now come into reality as this perfect digital settlement layer, and is only going to grow in importance. And I think, yes, we never got fully the medium of exchange from store of value, but that's nothing to be shy about. It's worth, $2+ trillion today. It's easily going to overtake the market cap of gold in the next 10 years, and likely will be the most valuable asset in the world for, probably forever at this point. And it was just a very different view. And if you think, there's a lot of companies that were spinning up around that time. It was Bitcoin remittances, Bitcoin, there was a lot of technology that was based around that. And then in reality, exchanges and custodians kind of wound up being the two killer use cases in terms of the product companies. And then you get wallets, et cetera. But that was really kind of the difference in what we thought was going to happen versus what really happened.
Yeah. And it's funny because there's still some high profile Bitcoin guys who still talk about, Jack Dorsey, for example, right? Jack Dorsey, founder of Twitter, which is now X, but he's still in the camp that if you're not using Bitcoin as payments, then it's a failure. And what's your argument against that?
So, and I gave a longer, more in-depth discussion of my thoughts on kind of the zealotry and the usefulness of that and Bitcoin's early days versus where we are today on Breedlove's podcast about a month ago. But it's good to tune in and kind of check out my longer thoughts on that. But in general, I just don't believe in that. I think this idea of zealotry is now outlived a lot of its usefulness. I think it was very important in Bitcoin's early days of you need to will something into existence for it to become true. And when it was just, few thousands of people or tens of thousands of people around the globe that cared about Bitcoin versus now where it's, hundreds of billions of dollars in ETFs around the world and corporates and everything else. It's just totally different version of, what each individual can do to shape Bitcoin, which is both pro and a con, if you will, for a variety of reasons. But I think the idea that it's only useful as payments is just an outdated relic of a previous understanding. And I think that's what, if you think about who remains relevant in Bitcoin as time goes on, it's usually because they adapt their views over time. They don't get lost in, something overly specific. And I think what we stumbled upon as an industry was stablecoins. And that was really 2014, 2015, if I remember correctly, the first deployment on Omni. But in general, we realized that the killer use case for blockchains for payments is just a better dollar. And yeah, it's not what we wanted as Bitcoiners, but it actually achieves a lot of what we wanted, right? It's not purely centralized, not like, but okay, that's fine. You don't use gold for payments either. So the idea is you now have this ability to have these things work symbiotically with one another. And that value prop to, billions of people around the world to be able to have frictionless, fast, cheap payments that are hopefully uncensorable, not always, but there are other options for it to be uncensorable, if you will. And those are still huge wins that I think are very true to the ethos of what everyone was trying to do back then. But I think it's all about expanding your aperture and also kind of coming to terms with reality. If we were all stuck in our 2015 vision of the world, we would never have grown, right, as an industry. And it's just really important to keep updating your priors.
Yeah. It's interesting. I mean, it feels like now, I mean, even Wall Street has accepted this as digital gold, right? And it's pretty remarkable. I would say I'm class of 2017 here. Even from then, it's just what a difference when you look at it. One quick question about your thoughts on these Bitcoin treasury companies, specifically. Let's look at MicroStrategy, Michael Saylor's company. They're buying a lot of Bitcoin. Do you see fundamentally any problem or some concerns to the Bitcoin ecosystem when you have one company potentially owning 5% of the Bitcoin supply at some point?
I don't personally. There's a lot of consternation around this with the ETFs as well, and just like this, corporatization of Bitcoin generally, or even just the centralization of Bitcoin. And overall, I think it's good to have, essentially price insensitive buyers of these assets to help continue to bring Bitcoin forward. And I think Saylor's proved time and time again, he's willing to continue to back up the truck and, buy large and larger amounts of Bitcoin. And I think is one of the major responsible parties alongside of these ETFs of a lot of the price movement that we've seen since early 2024 in Bitcoin. And I think the positive pieces of that, these are also one-way black holes of Bitcoin, right? Like ETFs a little different. You have the in and out flow, but at least in terms of these corporates, these are a black hole, right? Like Saylor's not selling his Bitcoin anytime soon. And that's a win, right? It's a permanent capital vehicle for Bitcoin. And he's actually spurred this entire craze of all of these other folks also going to leverage and acquire more Bitcoin, which I think is net positive. Some of these people will mess it up. I'm not really as worried about the debt spiral or the death spiral of a lot of these vehicles. I think if they wind up trading below NAV for a large period of time, Saylor will just buy them. He's essentially, using dollars that are valued more than $1 to go buy things valued less than $1. That's a great trade. And I think you'll see people do that at size. My only fear of this full kind of corporatization of Bitcoin thing is related to the miners. And I think the miners are very cost sensitive in terms of their means of production. And I think over time, there is a world, which I hope we do not see, which is the only miners that can run their business profitably are these corporates who essentially do it at a loss, or governments, right, where you're willing to do non-economic things to help subsidize the network. That kills a little bit of the decentralization of Bitcoin story, but I think it's a solvable problem should we get there. But that's my only concern with it. But I think on the net positive, net trade-off scale, if you will, these are overwhelmingly positive for Bitcoin.
What do you think of this idea of, of the cycles? And, we had the halving, we had a little bit of a run up. If you look historically, the high part of the cycle is coming now, pretty much, right? Are those types of cycles and 80% retreats a thing of the past when you have that level of buying pressure from a guy like Saylor, institutions, governments? What's your feeling on this?
So I think the general shape of the cycles is very different than what it was previous. Like just your buyers and the structural demand is so different than what it was in, say, 2013, 2017. And my views on this have been, pretty influenced pretty heavily by Michael Turpin. He and I have spent a bunch of time together chatting about these sorts of things. He's also the author of the Bitcoin Supercycle book. So we've gone into detail on this, many a time. But I think the idea of like 80% drawdowns in Bitcoin at this point are pretty much over. I think you'll have severe drawdowns, but I think the idea of like 80% or something like that is very much in the past. And then you also have just these, not buyers, buyers last resort to some degree in terms of these treasuries. But I also think you have essentially nation state puts on some of these treasuries, right? So like there's just so much demand for Bitcoin that I just can't see that same massive drawdown happening. Do we hit the same peaks or is the volatility dampened? That's a great question. I think in this cycle in particular, it's probably a more elongated cycle. Like I don't know that we'll see, the crazy, blow off top in October that, so many are expecting. But I think we do have several macro pieces working in our favor here. Global liquidity is increasing. You've got rate cuts. You've got just a bunch of structural shifts and, kind of overall macro forces that I think will be very positive towards the end of Q4 and then through Q1 of next year. So I think there's some amount of cyclic behavior that I think is unavoidable in any asset, but I think this one is probably right shifted, if you will.
Bitcoin obviously year over year is doing well, but it has been remarkably stable in the last few months here. It's almost uncharacteristic. Like, there's such little volatility. It's almost like it's less volatile than the stock market. And, some people, I've been in the Twitter or X space, talk about this being the influence of quote unquote paper Bitcoin, right? Sort of this trading of derivatives and that kind of thing. What do you think is going on there? I mean, listen, it is kind of silly to look at like the amount of how much Bitcoin's gone up in a year and say that it's not doing anything, right? But on the other hand, you just look at how much is being bought just from players that we know versus how much is created in a week versus how, and you just wonder, why is this price not just continuously going up? Any thoughts on that? This paper Bitcoin conspiracy, that kind of thing?
So I'm firmly in and I've heard people talk about like paper Bitcoin summer and, kind of a few things along that. I don't believe that at all, just to be clear. I think you're now a multi-trillion-dollar asset. To go move this thing, you need serious capital flows, right? It's not like Bitcoin's 10 grand anymore. It's very different. So like you need just a very different, orders of magnitude different in terms of buying to go continue to move this. I think there's also like another piece that's worthwhile to dig into is the way the buyers come on is very different than the way the sellers sell, at least as we've seen over the last few months. And you see your MicroStrategy, MetaPlanet, Nakamoto, you name it, they're trying to buy Bitcoin without moving the price, right? Because they are trying to minimize the slippage that they incur. Well, if you look at the Hyperliquid Whale or some of these other folks who are trying to sell their Bitcoin in as fast, and potentially inefficient way as possible to go rotate into ETH or Solana or something else, they are not doing that, right? They're doing the exact opposite behavior where they're trying to cause price impact, whether it's to buy it back lower or to do something else. May or may not be manipulation. Your mileage may vary there, but I think that is a very stark contrast of trying to understand these flows. Because if you're trying to be very inefficient, you can move the price significantly more, even with as liquid as Bitcoin is, than if you are not trying to do so. And I think those market dynamics are important to understand. Another big kind of important thing to unpack here is you've got a lot of people that have made a tremendous amount of Bitcoin a tremendous amount of money in Bitcoin over the last 15 years. And you're now seeing people that have hit some of their price targets that they never thought Bitcoin was going to get to, that are now unloading huge amounts of supply, right? Like we saw Galaxy do a sale for like 8 billion over the summer. Like you're seeing size move in and out, and that has to get absorbed because for every buyer is a seller, right? Like that is how these markets work. And that also has to get absorbed into the system. So you're seeing Bitcoin, shift from more OG hands to maybe newer hands, newer institutions. And I think that's healthy. And eventually you will get to some new equilibria, and low volatility situations breed high volatility situations, right? And I think we're more or less gearing up for something like that.
Tell us what you think's next. And when you say that, when you say the low volatility is gearing up for high volatility.
So it's probably an unfavorable take at this point, but I'm still in the camp that I think we see close to, if not 200K Bitcoin by the end of the year. I've been saying this all year. So again, there's only so much time left, but I think there's been a more than people would anticipate in terms of like OG selling, and then also these, kind of rotations in a deliberate fashion out of Bitcoin. And I think we're gearing up based on, that stopping to some degree, as well as some of these more macro pieces starting to work in Bitcoin's favor. And I think we've already seen gold really break out, and Bitcoin hasn't, caught up to it, at least recently. And I think that's a catch-up trade waiting to be made.
Yeah. What's your what do you think happens in the next 3 to 5 years?
3 to 5 years is hard. On a 10-year time horizon, I'm very confident Bitcoin will be $1 million or more. 3 to 5 years is really hard because there's just so much macro that goes into that. Like, I feel very confident, in the next 2 to 3 years that we easily hit like, 250. Beyond that, it's really hard in between there. There's so many political pieces that get involved there. It's really hard. But on the 10-year, I'm, very confident.
Yeah. Yeah, it's a tricky one because especially right now, we have the benefit of having a very pro-Bitcoin cryptocurrency presidency and administration and all that, which is really helping. But gosh, I mean, who knows, 2 or 3 years from now, we could get somebody who trying to cut the legs off. So it's tricky. But anyway, I do appreciate all your thoughts here today, Rich. It's been good having you. Again, just for our people who are interested in core, what's the easiest way for them to learn more?
Easiest way to learn more, check out coredao.org or x.com. Still weird to say x, x.com/coredao_org. Tons of amazing materials there, and tons of interesting, AMA, community spaces, webinars, you name it. A million different ways to learn about core, and then also to get involved, whether it's in Discord as an ambassador, community member, you name it. There's millions of Cortoshis around the world, and we're always welcoming, more folks that want to get involved.
Cool. Thanks so much for joining us.
Awesome. Chat soon. Thanks.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. And again, that's good news, right? We're talking about potentially getting yield from Bitcoin in our own custody. It may not be a lot of yield, but it's better than just kind of letting it sit and cold storage doing nothing for the next 5 to 10 years, which I think is probably the smartest thing to do in general. But if you want yield and keep custody and you're willing to kind of check out what Rich is doing, it's an interesting opportunity. Anyway, last thing I'll just say, if you've not done so, make sure that you actively try to learn about Bitcoin. Because again, if you are sitting on the sidelines, you're hearing about this Bitcoin thing, saying, I don't want to be a part of it, whatever, do that at your own risk. Because, I think if you look at the next 5 years, I can't think of an asset that I'm more sure is going to be higher than it is today. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing out.